Hello, and a very warm welcome to CGAP seminar, Basic Regulatory Enablers for Achieving Universal Financial Access. We're delighted to have with us the financial sector specialists, Ivo Jenik and Max Matten. They're here to bring us their insights from the field on building an enabling regulatory environment and to discuss some specific case studies from countries. But first, let me just go over a few logistics for this webinar. This webinar will be recorded, so your microphones will remain muted during the entire session. When you want to ask a question, please use the chat box that's located to the right-hand side of your screen. You may submit a question at any time during the presentation, and then toward the end, we'll collect those questions and present them to the presenters. To ensure that your question is seen, please use that drop-down menu and click on All Participants. We will begin the Q&A session at about 9:15, that's Washington time. And as I said, this webinar will be recorded, and we'll be delighted to share a copy of it with you after the session, along with the publications that support the work that both Ivo and Max have been engaged in. So with that, over to Ivo, who will begin.
All right, so dear ladies and gentlemen, welcome to our webinar. My name is Ivo, and in the next couple of minutes, I will give you an overview of what we call basic regulatory enablers for digital financial services. So here's the agenda. I'll go very quickly over the sort of scene-setting introduction. Then I'll talk also about financial inclusion and digital finance. And then we'll zoom into 4 regulatory enablers, those 4 basic enablers that, that CGAP has identified. And after that, Max, who's here with us, he will give you examples of 2 countries that have implemented those enablers and what it actually did to their digital financial system, services ecosystem, and the financial inclusion. So before we really start with enablers, I think the first step to take is really to talk about financial inclusion and what we mean by that. So first component of financial inclusion is to making sure that poor people can access and use financial services they need to advance their lives. There are currently 1.7 billion people who are outside of the formal financial system, as the recent FinTech data shows. And what it means that they're excluded or outside of the formal financial system means that they do not have access to basic accounts, or they have a limited access to formal financial services. And for most part, they operate in cash economy. Now, when we talk about financial inclusion, it means that these people, these customers, potential customers of formal financial service providers, could get access to a variety of services, not only basic transactional accounts, but other types of payment services, including remittances, services such as savings accounts, credit, insurance, perhaps investment opportunities and products, and so on and so forth. And this access they can get through both the traditional financial service providers, but also the less traditional, such as mobile network operators, and the brand new ones, such as fintech companies and others. I already talked about fintechs a little bit. So since 2011, the share of adults with an account has grown steadily, bringing 1.2 billion more people into the financial system. But what we see is that while the access is growing, high account dormancy remains a challenge. So I talked about access to financial services, but another important component of financial inclusion is really the usage of financial services. And to improve the usage, financial services need to be convenient, they need to be responsibly delivered. Very importantly, they need to meet the needs of customers. They need to be affordable, of course, but I'd like to emphasize also that they need to be sustainable for providers. In other words, providers need to find it economically viable to deliver those services to customers. So digital financial services, theoretically and also practically, as Max will show, create this virtuous cycle where the digital technology enables things that were not possible before. And these are things such as overcoming the distance and the barrier to access through using technology and new distribution channels and reaching out to customers in rural areas who were previously not served by traditional institutions. Technology also allows financial service providers to offer tailor-made services that reflect specific needs of specific customer segments. And obviously, technology also helps providers to bring costs down so that they can now provide those services to customers who are at the base of the pyramid with lowering costs and make that business model work sustainably. So this is why digital financial services are important in financial inclusion space. They create this new opportunity to bring more people into the formal financial sector. But the digital component also poses new challenges for policymakers, things that policymakers need to be aware of. And so here are 4 major characteristics of digital financial services for excluded customers that policymakers need to take into account when considering any policy intervention. First of all, it's a customer profile. So since we're talking about financial inclusion, we talk about people who are financially excluded or underserved, and that also means that they have very limited or zero experience with formal financial services. That also means lower financial literacy, but also often low literacy generally or low numeracy, things that make customers more vulnerable and potential targets for exploitation. The second characteristic is new providers and business models. I've already mentioned those. So mobile network operators, fintech companies, big technological companies providing financial services, and completely new types of entities such as crowdfunding platforms are playing an increasing role in the digital financial services and in financial inclusion, but they also come along with different types of risks that regulators need to be aware of and address. Then it goes without saying, a third characteristic is intensive use of digital technology that comes with benefits but also risks around cybersecurity, data protection, and privacy. And finally, use of agents. Digital financial services are very often operating in a virtual space, but there is still need to create a physical touch point so that customers can cash in, they cash out, they can have in-person interaction with the financial service provider, and this is very often done through agents. So these are 4 major characteristics of digital financial services for financial inclusion that we need to keep in mind when talking about policy making and regulation. Now, several years ago, CGAP asked this question: what are basic regulatory enablers for digital financial services for financial inclusion to emerge and thrive? In other words, is there any minimum set of regulatory measures to be taken so that the digital financial services ecosystem can emerge and can effectively serve people who are excluded or underserved? And when we say basic, by the way, I need to emphasize that we don't mean simple or easy to implement. It really means the baseline, the regulatory baseline. And so we asked this question and tried to answer it with a thorough research across 10 different countries in Africa and Asia, but also throughout a very thorough consultative process with different types of stakeholders, where the lessons that we learned from on the ground were then testing in different contexts and with different stakeholders, trying to see what the basic enablers are as compared to more advanced and so on. And so we arrived at 4: allowing non-bank e-money issuers to operate in the market, allowing financial service providers to use agents as their distribution channels, creating customer due diligence that is risk-based, and creating a framework for protection of customers. Now, I should warn you that we don't have really time during this webinar to go into very detail of each of those enablers. This is what our publications and knowledge products do, and we'll give you links at the end of this webinar. But I'll give you the highlights of what is covered and what are the main areas of focus for each of those enablers. So let me start with e-money issuers. And I would like to start with an example from the African continent. I already talked about Findex data. I talked about improvements in financial inclusion, but it's important to emphasize that those improvements, for most part, are still driven by traditional institutions, bank accounts. So let's use African banking market as a sort of segue into this non-bank e-money issuer section. Africa's banking market is second fastest growing globally and second most profitable. But at the same time, it's also among the least efficient ones globally. So while you see that cost-to-income ratio is below the global average, it's not due to efficiencies of the market, it's more due to high margins in the banking industry. Because when we look at the cost-to-asset ratio on the very right side, we'll see that Africa actually scores above the global average. Now, we will not get into the details of why it's happening, but in this context, there's no wonder mobile money drives progress in financial inclusion across Africa. And this simple point illustrates why e-money issued by non-banks is key to digital financial inclusion, particularly in certain regions. So allowing non-banks to issue e-money is critical in certain regions. Now, thinking about regulating e-money and non-bank e-money issuers, there are two major areas of focus. Regulators first need to define what legal definition of e-money is, and that typically happens through defining its function and nature. So e-money facilitates payments, it stores value electronically, but it's different from deposits. In most jurisdictions, e-money is not considered to be a bank deposit. Then the second area of focus is defining who and under what circumstances can issue e-money. So defining eligibility, capital requirements, both initial and ongoing, defining what activities non-bank e-money issuers can engage in, and also creating a framework in which customer assets are, or money, if you will, are being protected. Now, when policymakers ask those questions, how to regulate eligibility, capital requirements, and so on and so forth, they have a variety of options they can choose from, and so they're very often are sort of left wondering what would be the right capital requirements or the right sort of permitted activities. And in this context, again, we'll not go into detail, but it's important to really embrace the concept of risk-based regulation. And to illustrate the point, I'd like to use this visual to sort of compare two products that are very similar from customer point of view, but very distant from the point of view of the provider or regulator. So first one is a basic bank account, transactional account provided by a bank, where a customer deposits money, the money goes to balance sheet and is intermediated by the bank by providing loans to different types of borrowers. So in this process, in this financial intermediation, a lot of things happen, including liquidity and maturity transformation, and that goes with a set of risks. You can imagine that there can be too many depositors asking for their money back, and bank might have hard times to find that money because the money has been lent. So over time, we have developed a very robust frameworks to deal with those risks, such as Basel III, for example. On the other hand, you have a non-bank e-money issuer where, from the customer point of view, the product looks very similar. It's a mobile wallet, basically transactional account. I give my money to the e-money issuer. The money goes somewhere to the balance sheet, but it's not being intermediated directly by the non-bank e-money issuer, but very often is being deposited at trust account that is managed by a trustee, which is typically a prudentially regulated institution such as a bank. So in this scenario, the risks are a little bit different, and they're mostly focused on the market conduct and consumer protection. And this is something that regulators need to understand so that they can create a level playing field, but also proportionate to the risks posed by those different players. Let me now focus on another game changer, which is regulation of agents. Agents really solve that financial inclusion challenge of distribution, particularly in remote areas where brick-and-mortar distribution scheme, a traditional scheme associated with big banks, would not necessarily work and would not be economically viable. We actually know that countries that allow bank and non-bank e-money agent networks have financial inclusion rates 11.8 percentage points higher than those without regulations. And so it is good news that 85% of jurisdictions do permit financial service providers to contract with agents. Now, from the regulatory point of view, the regulatory areas are, for most part, dictated by the nature of the agent-principal relationship, where principal is typically responsible for acts of, or liable for acts of agents on the principal's behalf. And so we see three major areas of regulation. One is around integrity, making sure that agents are not being exploited or are not creating loopholes for fraud, for money laundering, for terrorist financing. The second major area is around reliability and security of services, making sure that agents can serve their customers effectively, have access to the systems that they need to serve their customers, can manage their liquidity so that customers do get their money if they need it, and so on. And perhaps, I would say perhaps the most important area is around market conduct, making sure that customers are treated well by agents, and agents are not committing fraud, are disclosing information, and are treating customers fairly, because let's not forget that agents very often are the face of the financial service provider and the only contact point, or the contact point that stands between the customer and the financial service provider. So their treatment of customers is very important. Now, a couple of major points here. In addition to agents solving the challenge of costly brick-and-mortar branches, it's very important to really allow a wide spectrum of financial service providers to use agents, because we see from, for example, the recent World Bank survey on consumer protection and financial inclusion that there is still an uneven playing field where only certain types of financial service providers are allowed to use agents in certain jurisdictions, while we believe it's better to create an even playing field where all financial service providers can do that. The other point I'd like to mention is something that you might have heard before, and that is around exclusivity of agents. Many regulators seem to be highly concerned with the question whether agents should or should not be exclusive, that is, whether they can provide services on behalf of one single institution that is being exclusive, or provide services on behalf of multiple different financial service providers that is being non-exclusive. A lot of paper has been covered by words on this topic, but we generally believe that regulators in the first place need to monitor what's happening in their market and only then decide whether they want to regulate exclusivity or not. If they see, for example, that exclusivity leads to anti-competitive situation and anti-competitive practices, then they may want to intervene and address exclusivity. If they see that non-exclusivity is confusing customers, or it's creating prisoner's dilemma, so to speak, where providers are hesitant to invest in developing their agent networks, they may want to intervene against non-exclusivity. But a priori intervention is probably not necessary. The third enabler I'd like to talk about is consumer protection. And you may be wondering whether consumer protection is really an enabler, because you don't need to have a consumer protection in theory to make financial services emerge and serve customers. But we know that among the key barriers to financial inclusion is trust, a lack of trust. And we talked about vulnerable, inexperienced customers, and so perhaps for them it's even more important to know that they can trust financial service providers, and they can know that if something goes wrong, there are rules that can be enforced, and they can be, for example, compensated. And so from this point of view, consumer protection framework is really very important because it addresses that issue of trust. And Another reminder, in addition to customer profile, is that we also talk about new types of providers and business models. We talk about intensive use of digital technology. We talk about using agents as a distribution networks. And all of these characteristics of digital financial services needs to be addressed one way or another, or needs to be reflected in financial consumer protection rules. Let me illustrate it with one example that sort of cuts across those different characteristics. And this is basically disclosure over the mobile money platform. On the left-hand side, you see a provider from Kenya. I mean, I'm not going to conceal the countries because they're evident from the currency, I guess. On the right-hand side, you see a very similar transaction performed in Tanzania. And what is important to emphasize here that those transactions are effectively identical. There is a fee involved. It's a basic peer-to-peer transaction. And you see that the level of disclosure, the amount of information provided is quite different. While on the left-hand side, there's no disclosure of fees, so the customer sort of executes it or make the transaction without necessarily knowing how much the transaction will cost. On the other side, it's very evident from that screen. And so this sort of alludes to what are the challenges that policymakers often face just because technology being implemented as part of the value proposition. Now, in addition to transparency and disclosure, there are three other major areas for financial consumer protection. One is around protection against fraud. One is, not surprisingly, around data protection and privacy. And the fourth one is around consumer recourse and complaints handling. And again, we will not go into details of how these are regulated and what are options available. But I'd like to mention here that while technology creates a challenge for policymakers that they need to address, it also creates opportunities, how this challenge can be potentially addressed. And so let me use consumer recourse as one example. There's been different examples of technology improving customer experience when it comes to complaints handling. By opening new types of communication channels, it's becoming increasingly easy to file complaints, but also implementing technology to address those complaints. Providers are using artificial intelligence or machine learning to process complaints data, to decrease the response time, and to make the whole process more customer-centric and efficient. So key points to remember for financial consumer protection: effective consumer protection helps to build trust. Multiple digital financial services channels, product actors introduce unique challenges, but also introduce unique opportunities how to improve customer experience and consumer protection. The last enabler that I'll go briefly about is customer due diligence, risk-based KYC rules, if you will. So we know that overly restrictive customer due diligence can be a big barrier to financial inclusion, and you've probably heard about issues such as de-risking. So how this dynamic happens? If you have, as a regulator, too strict customer due diligence requirements, you would unnecessarily exclude customers from the formal financial sector. And this will grow the cash economy, which makes transactions monitoring in the formal system harder because now there are much more cash-based or informal transactions in the shadow economy rather than transactions in the formal system where they are easier to track. That obviously hinders consumer protection as well because customers who are now being served by informal providers are less protected, arguably. And this ultimately undermines both combating of financial crimes because you have much bigger informal economy, a lot of this happening outside of the formal financial system, so it's harder to monitor, but it also worsens financial inclusion because not that many people make it into the formal financial system. And so this is why it is important to create those integrity rules, mostly anti-money laundering rules and counter-terrorist financing rules, based on the actual risks that are identified in the system, both at the macro and micro level. And how it can be done, there are different ways. I'll give you one specific example of simplified customer due diligence that reduces compliance burden in line with level of risks identified. And the specific example is around tiered approach to accounts that's been implemented by Mexico among multiple other countries. So the idea of tiered approach is very simple. You can create different tiers of bank accounts or transactional accounts based on the risks associated with each of them, with the customer profile, but also with the profile of that actual product. So in Mexico, for example, level 1, that allows customers to open an account without producing ID is only available to individuals and is associated with a set of limits. For instance, the maximum deposit per month is $225. And now you can compare this with the highest tier, level 4, where there is no ceiling. There also can be no other limits attached to it, but full customer due diligence is required, which means customer needs to produce a full suite of products to prove identity and source of income, among other things. So these are just examples or very simple examples where risk-based approach to AML-CFT is really essential, and it allows people who do not have enough documents that would be typically required to actually open some minimum basic banking accounts or transactional accounts and get access to other financial services. It's very important because currently there is 1 billion people who have no way to prove who they are, and there's probably far more people who do not have access to formal national ID or other form of formal identification. So in this context of this fourth enabler, it's also quite essential to mention that ID systems and digital technology play an important enabling role because we see now initiatives around digital IDs. We see initiatives around eKYC, cooperative ways of identifying customers and monitoring transactions. So this is a very high-level overview of our 4 enablers. As I mentioned, more details can be accessed through our publications and other knowledge products. But I'd like to pass words to Max now, who will give you specific examples of how those enablers being adopted can powerfully improve financial inclusion in our markets.
Great. Thank you so much, Ivo. And thanks, everyone on the line for joining us this morning or evening, wherever you may be. So I wanted to just give a quick overview of 2 country cases where we at CGAP have seen these regulatory enablers actually driving DFS adoption and usage, and in turn, are contributing quite a bit to financial inclusion in both countries. So starting off with Tanzania, what we saw was a very progressive regulatory approach in the early days of mobile money. And what that allowed for was kind of this explosion in growth early on, where by 2014, you saw Tanzania really leading among African nations in terms of adoption of mobile accounts. And by 2017, we see that the Findex numbers show us that there was 39% of Tanzanian adults did have a mobile account. Now, Ghana, and we'll get into this in more detail in a bit, but Ghana took a very different approach, and I think that these 2 cases are quite illustrative. So Ghana really started off, in those early days of mobile money without really fully trusting or understanding these new services and took quite a restrictive approach. And what you see is that really dampened growth before the government decided to revisit those regulations and created this kind of facilitating environment for DFS, leading now Ghana to actually catch up to Tanzania among the top nations in Africa in terms of adoption of mobile money. So let's dig into these cases. Starting off with Tanzania, what we saw in early 2008 was neighboring Kenya had just seen kind of the first at-scale deployment of mobile money in M-Pesa. And so Tanzanian regulators really were faced with a conundrum. what do we do about these services? Do we crack down on them? Do we kind of say, no, we want to keep financial services to the formal banking sector? Or do we kind of take the approach that our neighbor did in allowing these services to go to market and kind of learning about how these things work, what are the risks, and developing regulations that are proportionate? Well, what Tanzania decides to do is to adopt enabling regulations early on. So first, they allow non-banks to become e-money issuers. So in this case, the telcos or mobile network operators. And they also allow these non-banks to develop their own agent networks. And what this does is it allows space for early investment. And what you see is the telcos just pouring money into these new services. So on the left on your screen, you can see the number of agents in the country. So from 2009, when the first service was launched, all the way up to 2015, and you can see an explosion in the number of agents in the country. This is indicative of kind of confidence in these services and willingness to invest. Now, on the right, what you see is the increase in volume of transactions. And so what you're seeing here is that because the providers feel the confidence to invest, you see an explosion in actual usage of the services. So you can kind of see this correlation between the regulatory approach and the success of digital financial services. Now, like I said, this was a very kind of tentative approach. We call it test and learn. So, at the time in 2008, there wasn't much known about these services. But by 2015, Tanzania decided to codify its approach into formal regulations. And these included many of the regulatory enablers that my colleague Ivo just presented to you. Non-bank e-money issuance, use of agents, risk-based customer due diligence, and some consumer protection elements. And I'm sure that if there are questions on it, we can revisit it, but this may have been sort of the weakest part of Tanzania's approach at the time. And then just to emphasize the importance of this of these enabling regulations, you can see that by 2017, mobile money had become the most important contributor to overall financial inclusion in Tanzania. And so, as Ivo mentioned before, because of the kind of unique context of the financial sector in many African nations, the ability for mobile money to overcome some of these traditional barriers to accessing and providing financial services, it really has the potential to change the game when it comes to financial inclusion. Turning to Ghana, which, again, very different case than Tanzania. So in 2008, when Ghana saw mobile money taking off in Kenya, regulators were quite apprehensive. They didn't want to replicate the Kenyan experience. They saw it as incredibly risky to be allowing these non-banks to get into the provision of financial services. And so what they decide was, at the time, they say mobile money was, at best, a channel for use only by banks and deposit-taking financial institutions. And the regulations followed that belief. So first of all, in 2008, they released branchless banking guidelines that say, first, that only banks are permitted to become EMIs and only banks are allowed to use agents. Secondly, that EMIs must consist of a partnership between at least 3 banks. And we can get into this in more detail if you want in the Q&A, but the reason behind this was kind of an early attempt at interoperability by forcing banks to partner with one another so that you had kind of this many-to-many system where no one provider could control these payment systems. And then finally, you had mobile network operators that are serving as agents of the bank. They're actually, building out these services on the ground, but actually have no direct channel to the central bank, and so no way to discuss regulations, raise their concerns with the regulator, et cetera. And what happens, somewhat unsurprisingly, mobile money falls flat. By 2011, there were only 100,000 active mobile accounts in Ghana. If you contrast this with Tanzania, I mean, it's just night and day. By Tanzania, you already had millions of accounts. This was due to 3 key problems with the regulatory framework. So first of all, we have this problem with passive partners. So you have these banks who are all kind of partnered to deliver these services, but no one wants to actually take responsibility because they don't want the fruits of their investment to go to their competitors. So no one's investing in agent networks. No one's investing in marketing, customer awareness, customer education. Secondly, without the banks investing, the MNOs, these telcos, are forced to pick up the slack and actually build out these services on the ground. But you can imagine that if you don't actually own a service, it's incredibly difficult for you to justify making kind of the very costly investments in physical infrastructure that are required to actually deploy these. And so, unsurprisingly, no one's investing. And then finally, as I mentioned before, there's this communications gap where the MNOs just have no seat at the table when it comes to discussing regulatory issues with the central bank. So, as one of the former heads of one of the big mobile money operators in Ghana recounts, the banks were supposed to recruit the agents. They were supposed to promote the product. They were operating, but somewhat unsurprisingly, they were not operating fully. So what we see, though, is that in 2013, the central bank signals that it's going to revisit the regulations and try to address some of the issues that were serving as impediments to growth in DFS. In 2013, you see them begin to draft these new regulations. And I would just like to call your attention to this graph where you see that on the right-hand side, when we're talking about active mobile money agents, in 2013, there were very, very few agents in the country. But almost immediately when the drafting process begins, a signal is sent to the market that they're going to open this up. And you just see immediate investment from 2013 on. And that investment in agents, in turn, drives greater volume of transactions. And then in 2015, the regulations are formally issued, and you see an even more rapid acceleration of investment in the market and uptake of the services. And again, as our friend Ellie over at the bank or former Bank of Ghana head of Payment Systems Division recounts, this was just what the telcos were waiting for. They just spread their wings. So just to review what was included in those guidelines in 2015, first of all, allowed for non-bank e-money issuance. Second of all, allowed for non-banks to use agents to build agent networks. Third of all, established tiered KYC. So for mobile money accounts, there is a lower standard than there would be for, say, a full deposit account at a financial institution. And it also established some strong consumer protection rules around these services. And again, I think this we've already demonstrated it multiple times, but you just see an explosion in Ghanaians' use of mobile money. Today, according to the Findex numbers, it is a total of 39% of Ghanaian adults are using mobile money. By far, again, the biggest contributor to financial inclusion in the country. And we see this kind of trajectory continuing, with Ghana going from one of the lowest usage rates of DFS to one of the highest on the continent. And just because I'm in a good mood this morning, I thought I would throw in a bonus case study for you. I think it's always good to just demonstrate that these are not isolated cases that are exceptions to the rule, but rather that these are proving that this kind of enabling approach to regulations does have an impact on uptake of digital financial services. So let's look at Cote d'Ivoire, one of Ghana's neighbors. Very similar approach to Ghana. Early on, 2006, decide to prevent non-banks from becoming electronic money issuers. They forced the MNOs to partner with the banks. The MNOs are expected to be driving investment, but of course, they have no control over the services, no communication channel with the central bank, and that leads these things to kind of stay, these services to really remain quite dormant. Now, again, like Ghana, in 2015, the central bank decides to revisit its regulatory enablers, and allow non-banks to become EMIs and build agent networks. And what we see is a very, very similar story. So explosion in the number of active mobile money agents, in the value of transactions, and again, the only kind of contributor to increases in financial inclusion in between the 2014 and 2017 Findex was mobile money. You see that financial institution account ownership actually remained flat. And again, Cote d'Ivoire now among one of the top countries markets for digital financial services in Africa. So to close things out, I just want to emphasize that while regulations are incredibly important, and I think that we've demonstrated that today, there is more to it than just having the right regulations in place. And I'm sure that many of you on the phone have been to markets or are currently in markets where maybe the regulations are enabling, but yet there are still obstacles to growth of DFS. And so what we've identified are some of these other pieces that play an important role in fostering an inclusive payment ecosystem in emerging markets. So first of all, enabling regulatory approach. And I say approach rather than regulations themselves because, technology is rapidly changing. The issues that regulators have to deal with are changing on a day-to-day basis. And you need to have a progressive regulator who's ready to deal with these new issues and the new problems posed by rapid innovation. Secondly, executive commitment and investment. So what you saw in all of the markets that we looked at today was that when the regulatory framework was in place, you had progressive leadership in industry that was ready to take the reins and kind of take advantage of this regulatory framework to drive these services, even when in the early days of mobile money, there was very little information around whether these services would ever become profitable. I mean, these were lost leaders. They were losing money at the beginning. So you really had to have leadership that believed in making these investments in agent networks, in customer education and awareness and marketing, et cetera. Third, and a competitive landscape is important for driving innovation and value for customers. And I think that you see different types of competition from market to market. So it's not just MNO versus MNO, but it could be a range of dynamic player types, banks, fintechs, telcos, all offering, sometimes in partnership with one another, different types of services at different price points and with different value propositions to customers. Fourth, we continue to believe at CGAP that interoperability, interconnected services, the ability to transact between account and provider types is incredibly important for making it as frictionless as possible for customers to use these services on a day-to-day basis. And finally, that at the end of the day, it's all about providing compelling use cases. So giving someone an account, I think we all can agree, is not enough. It's what can you do with this account? And so in order to continue to drive usage of these services, we really need to make sure that the use cases that we offer do meet a compelling need among the customers we're looking to serve. And so with that, I will open it up to questions for both of us. Thanks, everyone.
Yes, there's indeed more to life than just regulation.
Thank you very much, Ivo and Max, for really great presentations. A reminder, do enter any questions you have into the chat box, list all participants. I'd like to start with, we have several questions that have come in around agents and agent regulation. So firstly, would you like to talk a little bit more about how regulators can ensure that agents do not facilitate AML/CFTC? And specifically, does a KYC standard work for agents? And should it be the same as that applied to banks?
Mm-hmm. Excellent, great question. And since I also have your attention still, I'd like to throw a question at you as well, and that is whether you agree with our framing and those 4 enablers. So feel free to use the chat box, not chat bot in our case, to provide a feedback. Do you think that those 4 enablers that we've been talking about are really the 4 basic enablers, or do you see different ones, or do you see the number being lower or higher? So it would be quite interesting to hear from you as well. So now let me turn to agents and the question of how to regulate agents and how to make sure that they're not a loophole into the system through which money flows to terrorist organizations or money from criminal activities are being sort of integrated into the formal financial sector. Well, I'd like to make a couple of points here. First one is that it really depends on what kind of activities are agents allowed to do. And we need to acknowledge that there would be a variety of approaches across different jurisdictions. But generally speaking, when it comes to AML/CFT requirements, we talk about two major areas. Initial identification of customers, so account opening. In some countries, this is not necessarily done by agents directly. And then the second one is the ongoing KYC, as we know the term. So making sure that customers are not using account in a suspicious manner for money laundering or terrorist financing. And so for the identification part, if agents are allowed to open accounts, which is great, obviously, if they are, it's important to ensure the similar standards to other financial institutions, taking into account the risk-based approach. So making sure that customers who may not have the full suite of identification documents can still open accounts if they are lower risk, and then making sure that agents know what documents to ask. They have ways to register those documents, send them to principal, and basically perform the initial customer due diligence. When it comes to KYC, the ongoing monitoring of transactions and customer behavior, if you will, my question, sort of rhetoric question, would be, who is best positioned to do so? Is it agents who do have a visibility into a particular transactions of a particular customer at a particular point of time, or is it the principal who has access to all the transactions and with the use of technology can potentially monitor transactions across different agent locations, across different time schemes, and so on and so forth. So I think there's very often perception that the burden of AML-CFT dwells heavily on the shoulders of agents, but I think technology is telling us that, or is sort of hinting to new ways of doing AML-CFT and leveraging data monitoring systems and data analytics on the principal side to make it more efficient and perhaps take some of that burden from agents. There was a related question to this, and that question was around supervision of agents. So I'd like to connect the two and sort of expand my answer to that. That's obviously a question that I'm sure the question was asked by a regulator, because regulators do struggle with this conceptually. Because we know that while there might be, hundreds, perhaps thousands of branches, depending on the size of the market, there are definitely thousands, hundred thousands of agents. And so that puts a lot of pressure on supervisory resources if supervisors are of the opinion that they need to go and see every single agent once in a while as part of their on-site supervision. I would say that supervision of agents is obviously very important. And again, I will not talk about it too long, but technology can help. There's now projects in the RegTech area that are helping supervisors to leverage different methods, geospatial mapping of agents paired with transactions volumes and other things that help to sort of complaints data and other important source of information that help supervisors to get a sense of what's happening on the ground without necessarily setting their foot on the ground. But generally, again, I would say that the focus remains principally on the principal. So supervisors very often focus on principal, making sure that the principal has processes, policies, supervisory methods in place to make sure that the principal's agents are behaving well, but then using this feedback and other intel, including intel from the complaints, intel from deploying the RegTech technology, for example, supervisors should identify and perhaps sort of prioritize some of the agent outlets or some of the geographical areas for more thorough analysis or supervision, which is to say in many words that supervision of agents is not a matter of visiting every single agent once in a while, but again applying a risk-based supervision where important pieces of information can sort of narrow down the selection and make sure that supervisors are using their resources wisely where it matters most.
That's great. Thanks very much, Ivo. A question more related to providers for you, Max.
Mm-hmm.
how do you price digital financial services for sustainable growth? One of our participants noted that the Tanzania, and the example that you showed, charged a fee of about 22%.
Oh, that was the disclosure.
Yes, the disclosure fee. That seems rather heavy. Is that making it unaffordable for customers? Is that useless? I mean, what is a way of approaching pricing?
Yeah, it's a sticky question. I don't know if I have any good answers, definitive answers for that. But I do think that Dan, who asked the question, raises a very important point, which is that many of the fee kind of structures for mobile money services and DFS more broadly are quite regressive. So what you see is that transaction fees are higher as a proportion of the overall transaction for lower values, and as you move up the scale to kind of higher value transactions, these fees become smaller as a proportion. So really what you're seeing is you're penalizing the poor for using these services because they're not sending incredibly large sums of money, right? And so what I would argue is that a starting point, and I'm not necessarily arguing that this is a regulatory issue, but you know, it is certainly a subject of dialogue that should occur between the regulators and the providers. But we should start to think a bit more about what do we want long term for these services, right? Do we want people to use them often, or do we want them to only use them every now and then when they have a larger amount of money to send? And I think that this also raises questions for things like merchant payments, right? I mean, when you're talking about low-income people, they don't want to pay incredibly high fees for things that they could easily purchase in cash. So if we really believe in a cash-light future, and we really believe in the value of these services, and we believe that volumes will eventually drive profitability for these service providers, then I think that what is being done in many countries in terms of pushing these regressive pricing structures is quite counterproductive, and it's shooting yourself in the foot. You might get a couple more bucks today, but in the long term, what you're doing is you're really stifling the growth of these services. And what I would just point out is in Tanzania, you do see growth stalling, where early on it was one of the leading markets. It's now tied with Ghana, which, you know, when Tanzania was high flying, Ghana was barely registering any usage of these services. So the question that begs the question, you know, is this sort of short-term strategy of pricing these things to make as much money now as you can, is that really going to be sustainable over the long term? And I would argue it's not. But in terms of how we address that, I think that's a matter of debate.
And perhaps to add to this, I'd like to also emphasize the role of competition. And competition is something that is becoming a big topic on the radar screen of many regulators around the world. Obviously, we do believe that improving competition, improving competitive environment helps to also address a pricing issue and is perhaps a more reasonable regulatory strategy than just being hard on a pricing and sort of trying to intervene into the business operations of financial service providers. I'm saying that with acknowledging at the same time that many regulators, many financial sector regulators do not have explicit competition mandate. But in this context, it's perhaps interesting to mention that in our other work where we focus on innovation facilitators such as sandboxes, we've recently conducted a survey where we asked, among other things, what's driving those sandbox-like initiatives. And competition was number 3 reason for setting up a innovation facilitator such as Sandbox after, you know, the necessity to deal with fintech and learn about what's happening. And so it's interesting that while you have this contrast of a very few regulators having competition mandate, there is this strong push towards improving competition by deploying different regulatory techniques because it can help to address the pricing issue as well.
It's a really important
point. We've got rather a challenging question from Jeffrey Boyers. He is asking, how do you explain those markets where these regulatory enablers that you've been discussing are actually in place, but mobile money and other DFS services are not taking off? And specifically, he's looking at Latin America, North Africa, Middle East.
Mm-hmm. Do you want to take that one first, Steve?
Hi, Jeffrey. Thank you for great question. I really do appreciate it. I'll just give a brief thing, then maybe Max, you can talk about it. This is a very a painful question for us because we do believe that many countries have done a great job by putting those enablers in place, but then what they've done doesn't necessarily match improvements in financial inclusion. And I think this is partially due to what Max mentioned. There's more to life than regulation, and regulators can do as much as possible, but then the willing financial service providers need to come and find out how to profitably serve excluded and underserved customers. And so I'll let Max to go into that specific area. But I'd like to mention one more thing, and that is that there is a variety of approaches how regulatory enablers can be implemented, and that really matters, how you actually go about implementing them. Let me just give one example, non-bank e-money issuers. I mentioned that there's a different areas that needs to be regulated, including capital requirements. So nominally, you can have a framework for non-bank e-money issuers to operate in the market, but if you, for instance, require them to put in place a too high initial capital that is to be matched with banks, for instance, you're effectively killing their business. And similarly, you can have all those enablers in place, but if you levy too high tax on mobile money transactions, for instance, you can be, again, killing the business. So this is something important to emphasize, that while we talk about basic enablers, there's a lot of shades of gray or blue or whatever color you wish in how you can implement them, and that makes a difference.
Mm-hmm. No, I think that's just to very quickly add, because I think Ivo already touched on this. I mean, how the kind of dynamism of a market. I guess I shouldn't say dynamism, because many of the regions that you mentioned have quite dynamic financial sectors, but the players are slightly different, right? And so I think that the sort of the context and the legacy sort of infrastructure in the financial sector also will determine the way that these services grow, right? So I think that when you look at, thinking back to one of Ivo's early slides where he's showing kind of profitability of and like the cost structure of the African banking sector versus other regions, I think what you see is that in regions, say like Latin America, you see microfinance institutions and banks playing a much bigger role in serving lower income populations than you do in Africa. You also see kind of in North Africa and the Middle East kind of a legacy of a quite, if not incredibly inclusive, maybe a robust kind of traditional financial infrastructure. And so that will also determine the way that these things develop, right? Mobile money specifically was a very unique kind of creation of the African continent. It responded to a lot of the challenges that existed there. What DFS will look like in Latin America, North Africa, or the Middle East might be a little bit more like fintech or some other things that ride on the rails that this kind of more robust traditional financial services infrastructure does provide. I don't know if that's necessarily going to be the case, but I think it is a combination of what Ivo mentioned, kind of these other enabling factors for building out inclusive payment systems, but then also some of the kind of contextual factors that will determine how these things develop in the years to come.
How critical is it that the government at a high level takes the lead in driving financial inclusion? When you look at Tanzania, Cote d'Ivoire, Ghana, and then you look at India, how important is that role of government as opposed to regulators sitting down with the industry?
Yeah, I think that it's very important. We have a question here about India specifically, and many people on the phone would probably know that India government has put a lot of effort building what's called India Stack, which is really creating an environment for digital economy, not only digital finance, but digital economy to thrive. And I think it's very important, and it's very important for a number of reasons. I mentioned, for example, ID. We know that identification is a big challenge in many of our markets because financial institutions do have to comply with AML/CFT rules. And so the role of government in that regard is quite essential. But it also goes to issues such as open APIs, building a connectivity in their market. So I would say that the role of government and the role of infrastructure built by government or in the public-private partnerships is essential.
Mm-hmm. Yeah, I agree.
Ivo, Max, thanks for a really fabulous presentation, very, very interesting, and to our participants for joining with us and asking great questions. The webinar is being recorded. It will be available. We will mail a link to you, and it also can be accessed on the CGAP.org website under the events page. For the publications, I really highly recommend both works, the Basic Regulatory Enablers, that outlines the 4 enablers that Ivo has gone over, and also Inclusive Payment Ecosystems, which is a really great read looking in depth at the Tanzania and Ghana experience, for which Max was a key author. You can see those on your screen right now. You can use the QR code to access them, and we'll include those in the link. And we also have just posted in the chat box a link on our website to a page which also gives you easy access to these publications. Thank you very much, Max and Ivo, and thank you to all the participants, and have a great day.
Thank you.
Thank you.